If you're a non-resident Indian living abroad in USA, Canada or the UK and you're thinking about investing into the Indian stock market, then this video is for you. In this video, I'll break down the pros and cons of investing in the Indian stock market from the perspective of a non-resident Indian with a focus on long-term returns. I'll focus my discussions on returns versus risk of investing in India compared to the US market. However, your decision should factor in aspects beyond the financials, such as your life goals, plans to return to India, your income, age, and family situation. And as an investor, it is important to understand both risks and rewards of any investment decision. So I'll try to share with you a balanced view by discussing 3 potential drawbacks and 3 strong reasons to invest in the Indian stock market. My name is Kanak and welcome back to my channel. If you want to learn more about investing, then subscribe to my channel, and your support is what keeps this channel running. So show your support by liking the video and dropping your thoughts in the comment section below. First, I'll give you 3 good reasons to invest in India, and then I'll talk about 3 drawbacks of investing in the Indian stock market. So the first biggest reason is the long-term growth of the Indian economy. Over the last 2 decades, the Indian economy has consistently grown between 6 and 8%, and India has often been one of the fastest growing large economies in the world. The stock market is a direct reflection of the underlying economy of a country. This growth story of India is not over yet and possibly will continue for at least the next 2 decades. The reason for this continued growth is that if you look at the GDP per capita of India, when adjusted for purchasing power parity, it is roughly about $9,000 in PPP terms. Purchasing power parity adjusts for the cost of living of a country. So a $10 bill in India can buy you more things than the same $10 note in the United States. On the other hand, the GDP per capita of United States is $85,000 in PPP terms, which is almost 10 times that of India. Additionally, India has a population 4 times that of United States. So if every Indian produces and consumes at the same level as an American citizen, then the potential for Indian economy to grow is almost 40 times its current state. However, if we assume that over the next 2 decades, only 1/4 of India's population will reach the consumption level of an average American, even then, India still has a massive growth opportunity 10 times ahead of it. The second reason to invest in India is that over the last 40 years since its inception, the Indian stock market has had a successful track record of consistently demonstrating a strong growth rate. As you can see on your screen, the Indian stock market has grown from 561 points in 1986 to almost 73,000 points in 2023. That means the Indian stock market has multiplied 130 times in the last 37 years. That's a compounded annual growth rate of 14% over the last 37 years. And this growth rate will continue over the coming 2 to 3 decades because India has the advantage of having a low base effect. The low base effect simply means that it is easier to grow at a faster rate when the size of the stock market is small, whereas it becomes harder to grow at a very fast rate when the size of the stock market is big. The total value of Indian stock market is only about $4 trillion when compared to that of countries of comparable sizes such as China and United States. So the possibility of India growing at faster rate for a very long time is very feasible. The third reason to invest in India is because India has one of the youngest population in the world with a median age of 28 years. Whereas most developed countries in the West, such as USA or Europe, and the Asian countries such as China, South Korea or Japan have median population at or above 38. What this difference means is that India's population is still not at its peak consumption age, whereas the population in the developed world is already at their peak consumption age. Secondly, not only does India have the youngest population, but also a large proportion of this new generation is educated in the field of science and technology. Technology increases the per capita productivity of a nation. And when a country has a very large population that is educated in the field of science and technology, the total productivity of the country rises. As more young STEM educated people in India enter the workforce and start to consume during their working age, the Indian economy will see sustained growth in the future. Now that we have covered the 3 reasons to invest in India, let us talk about the 3 downsides to investing in India as a non-resident Indian. The first downside to investing in the Indian stock market is currency devaluation risk. This simply means that even though the Indian stock market has returned about 14% in rupee terms over the last 4 decades, when we convert rupees back to dollars, the returns are lower because rupee has depreciated against the dollar. This downside is crucial, especially if you plan to stay back in your country of residence and eventually convert the rupee into dollars. Let me explain with a simple example. If you had invested 100 rupees in Nifty 50 index in 2004, that 100 rupees would have turned into 1100 rupees by 2024. However, in 2004, $1 was roughly equal to 45 Indian rupees. So by investing 100 rupees, you invested roughly about $2.5 in the Indian stock market. But by 2024, $1 was roughly equal to 80 Indian rupees. So 1100 rupees in 2024 is equal to $14. This means if $2.5 grew to $14 in a period of 20 years, that's a 9% compounded rate of return in dollar terms. Whereas when we look at the total returns of S&P 500 for the same period of 2004 to 2024, we see that the S&P 500 returns roughly about 9.5%, which is about 0.5% higher than the Indian stock market. However, this might not always be true, and there have also been periods where currency devaluation did not have a big impact, and the Indian stock market gave equal or higher returns than the US stock market in dollar terms. But this example is more to demonstrate the fact that investing in Indian stock market involves the risk of currency devaluation, which can possibly negatively affect the dollar returns. However, past returns do not guarantee future returns, and there is a possibility that the equation can change in the future. The second downside to investing in the Indian stock market is the volatility risk. Volatility is simply a measure of price fluctuation. A stock or index that swings more in price is considered more volatile and hence more risky. On the other hand, a stock or an index that does not fluctuate in price as much will be considered less volatile and hence safer. If you are a long-term investor planning to invest for 10 years or more, short-term price fluctuation might not be your biggest concern. However, it is important to be aware of this risk before making an investment decision. Historically, the standard deviation of Indian stock market has been slightly higher than the volatility of the US stock market. But the difference in volatility is not huge, as the Indian stock market and the US stock market have more or less moved in tandem for most of the last 2 decades. However, the Indian stock markets have displayed more price fluctuation than the US stock market. The third very critical risk of investing in India is that the economic growth expectations of India may never materialize, and there is a real possibility that India might not achieve its full potential in the next 2 to 3 decades due to continued excessive government regulation, red tape, bureaucracy, or corruption. While the economic growth rate of 7% is higher than most other large economies, it is not exceptional. Given the small base of Indian economy, India needs double-digit growth rates to truly catch up and surpass the economies of China or the US. The US, with its $24 trillion economy, is growing at 3%, adding about $700 billion to its GDP every year. Meanwhile, China, with its $17 trillion economy growing at 5%, adds $800 billion of GDP every year. Even with a 7% growth rate, India's $4 trillion economy only adds $300 billion of GDP every year. In absolute terms, China and the US are growing their economies more than India. Moreover, India ranks 63rd in terms of ease of doing business, whereas China is at 32nd position and USA is at 6th position. While some people may question the accuracy of these rankings, they indicate that India has a lot of work to do to improve its business environment, such as reducing government regulation, bureaucracy, corruption, and red tape. Now, as a non-resident Indian, whether to invest in India or not would be your personal decision. Personally, I invest both in the Indian markets as well as the US markets, as it gives me both geographical diversification and helps me take advantage of investing opportunities offered by both the markets. I view the Indian stock market as a mid-cap stock that is on track and has the potential to become a large-cap stock in the coming decades. That's all for this video, and if you find this video helpful, then show your support by liking the video and hitting that subscribe button.